Stocks and bonds are two of the most commonly known investment options, but they are fundamentally different in many ways. Understanding these differences is crucial for investors looking to build a diversified portfolio. Ownership versus debt. The most fundamental difference between stocks and bonds is that stocks represent ownership in a company, while bonds represent debt. When an investor buys a stock, they become a part owner of the company and have a claim on the company's assets and profits. In contrast, when an investor buys a bond, they are essentially lending money to the issuer of the bond and will receive regular interest payments in return. Risk versus return. Stocks are generally considered to be more volatile than bonds, and therefore carry a higher degree of risk. This means that stocks have the potential for higher returns over the long term, but also have a higher likelihood of significant losses. In contrast, bonds are typically considered to be less risky than stocks, and therefore offer lower returns. However, some bonds, such as high-yield or junk bonds, can carry higher levels of risk and offer higher returns. Income versus capital gains. Stocks and bonds also differ in terms of the type of return they provide. Bonds provide a fixed income in the form of interest payments, while stocks offer the potential for both dividend income and capital gains. Dividend income is paid out by some stocks as a portion of the company's profits, while capital gains occur when the price of the stock increases. Priority of claims. In the event that a company goes bankrupt, bondholders have a higher priority of claims on the company's assets compared to shareholders. This means that bondholders are more likely to receive their investment back than shareholders. Maturity date. Bonds have a set maturity date, at which point the issuer is obligated to repay the face value of the bond to the investor. In contrast, stocks have no set maturity date and can be held indefinitely. Stocks and bonds are two different types of investment options that offer different types of returns and levels of risk. Stocks represent ownership in a company and offer the potential for both dividend income and capital gains, but carry a higher degree of risk. Bonds represent debt and offer a fixed income stream, and are typically considered to be less risky than stocks. Investors should consider their own risk tolerance and investment goals when deciding whether to invest in stocks or bonds, or a combination of both.